and welcome. You're watching KYC. I'm Harsh Saita. With me is Varsha Chandani. And, multiple ways to play consumption. One is obviously directly through B2C companies, front-facing companies, a Britannia, a Nestle, some AC manufacturers, a Symphony and the like. Then you have another way of playing consumption, which is you'll start looking at the raw material companies, something like a Galaxy Surfactants, right? Something like a soda ash manufacturer, like a GHCL. So to try and set it up, GHCL is the company that we're going to speak about today. Plenty of free cash flow coming in, a decent size in terms of business, a decent valuation as well. But there is obviously a set of risks that something like a GHCL runs. And one of those risks is the fact that they manufacture soda ash, and a lot of this is linked to China, both in terms of production as well as supply. Now, what happens there largely determines pricing here, and therefore you start to just wonder whether there will be pressure coming in the near term at least, because at some point that pressure will come through. So first off, this is what we'll try to understand as to whether China is a factor at this point or not. Q2 was supposed to be a soft one, is what Varsha tells me. Now, how is it looking like as of now? We're now almost through Q2. So we'll get a better perspective or better sense. Of course, there may be certain caveats which may come through, but at least hopefully we'll get some kind of a flavor on how Q2 is playing out. It was supposed to be soft. Is it as soft as maybe they were penciling in? Capex, 300 crore. And they're going to do this on an annual basis. They're going to continue to grow the supply side of things. Mind you, this company was also into textiles, by the way. They divested the entire textile business. They've doubled down on the soda ash business. Now, that part of the pie is virtually 95% plus of the business. And therefore, all of this capex will go on that side of things, which is soda ash. It's the number 2 soda ash player. And therefore, what does this do to both when does the capacity come on stream, so the timelines for that, and second is the turnover. How is this going to impact the top line number, which has stagnated for a very long period of time, right? Varsha, you want to see, if you're investing in India, you don't mind paying a higher multiple as long as you get some growth. So I want to see how much can this number go up by. Now, number 4 is the fact that cash flow utilization. They are doing 300 crore of operating, 600 crore, I beg your pardon, of operating cash flow every year. On a 3,000 crore top line, they're doing 20 to 25% margins, which is 600 crore of cash flow. The debt isn't that substantial, frankly. And therefore, what are they going to do with this cash flow coming in? And they've been repaying around 100 crore out of debt last couple of years. Now that they are close to debt-free status, what's the outlook like with regard to the 300 crore of cash flow that they are not going to allocate to capex? Now, the 5th piece is concerns on increasing working capital cycle. Now, while this could be a low-risk item and it's not translated last couple of years, but I want to understand whether this risk is real and live or not. Could this at some point of time translate, or is this not a concern whatsoever? That's what I want to know. And the last piece of this is the stability in the top line and the margins. How much of the contracts that they have with their customers, how stable are they, for how long term are they, and how much can we rely with regard to the current top line number for it to just keep going up, even if not at a substantial clip, but even stability on that number will help. Even a 5% growth with stability may help give us a perspective both with regard to top line and margins, and really, really good numbers overall that we will see and we will discuss. But Varsha, about the company.
Yeah, thank you for that. So as you rightly pointed out, this is the second largest manufacturer of soda ash, has almost 26% of market share. Now, what is soda ash? So it's nothing but, it's also known as sodium carbonate. Is a white, odorless, water-soluble salt, and has a wide range of industrial and domestic applications. So for example, the largest use of soda ash is in the manufacturing of glass, because it makes glass production more energy efficient and easier to ship. Also, the soda ash, also manufacture sodium bicarbonate, which is also known as baking soda. But they are also into consumer products. But 98% of their revenue comes from soda ash, but 2% comes from consumer products like edible salt, industrial grade salt, and one of the honey they make, that is jujube honey. Now, I was talking about the soda ash product offerings, that as Harsh was mentioning, one of the proxy play to consumer business. So, soda ash is actually used in soaps, in detergents. For detergents, it acts as a water softener, in solar glass, as I told you, and in flat glass. So, these are the products, or these are the segments where soda ash is being used largely. Now, onto the geographical expansion, or rather geographical analysis, if I were to talk about, 96% of their revenue comes from domestic market, that is India, and 4% from export. So, basically a domestic focused company.
Yeah, sorry Varsha for that. This is one of those, again, we've tried to pick some of these even on purpose. When you're looking at the export number, no tariff impact whatsoever.
Yeah, no tariff
Everything's
impact.
domestic, so no concerns there, right?
At
least that headway is something that one can look for when you're looking at companies like GHCL. Anyway, Varsha, please go ahead.
So, so this is basically what company does in a simple language, that they manufacture soda ash. Now, onto the capex, which is the next leg of growth. So, they are going for, onto the current capacity, so soda ash capacity stands at around 12 lakh metric tons. And even if you see their sodium bicarbonate, which is your baking soda capacity, is at 120 KTA. And also, now the main important thing is, what is the capex? What is the expansion that they are doing? They are setting up a capacity, bromine capacity. Now, what is bromine? Bromine is a heavy, volatile, I would say a reddish brown liquid, which is used in your water treatment, in your oil and gas exploration. If you know about Neogen chemicals, they are into bromine derivatives, so they make value-added products from bromine. If you know Archean chemicals, they are into bromine. So what they are doing is they are setting up capacity of 2,800 metric tons of bromine, and they're going to generate 40% EBITDA margin from this. Now, this is what as company says. Also, for vacuum salt, if they're setting up capacity of 1.7 lakh metric tons at existing plant in vacuum salt, and they're also gonna go for value added products which will be derived from soda ash. Now, what I want to understand from here, as Harsh was talking about the margins, because you're going into value added products, is there a chance to increase your margins? I'm gonna ask to management as well. Also, they're also going for greenfield and bromine projects. So, soda ash phase 1 and phase 2 capacity plus bromine capacity of 10,000 metric tons. So, this is nothing but the capacity expansion that they are planning to, and this will add the revenue, this will add incremental revenue for the company, which has been flat over the years. So, overall, this is the business model for the company and the capacity expansion that they are doing.
Okay, let's start off with the metrics. Therefore, we'll start off first, of course, as always, with the income statement, the balance sheet, the cash flow, the shareholding, the return ratios, the street cred, the street coverage, and the valuations. And let me start off, or rather, I'll allow Varsha to start off with the income statement, as always.
Yeah, thank you for that. So, income statement, if you see, there's been, I won't say problem, but fluctuations, when it comes to your profits. So, if you see from FY24 to FY25, the revenue has seen The three-year CAGR revenue has been 2%. The EBITDA CAGR, if you see, has been 9%. But look at the net profit CAGR has been -1%. Now, there has been challenges that the company has faced. This is because of realizations. So, realizations, the prices, the end product prices, that is the soda ash prices, have gone down. The realizations have gone down, and that's one of the reasons why the revenue has seen a declining trend. So, in FY24. From FY24 to FY25, if you see, there has been declining trend when it comes to revenue. Now, why? Because of the global uncertainty and abundant supply of soda ash. Because there was too much of supply of soda ash as compared to demand, your realization, your end product prices has gone down, which has impacted your revenues. And one of the reasons why you're seeing, a muted or rather a declining trend over revenue. But over the margins, if I were to talk about, from FY24 to FY25, the margins have increased because of the cost optimization strategies that the company has taken, and of course the better operating leverage that the company has seen. But I want to just talk about the overall margin trajectory, which is important. Now, if you see, from 24%, it has come to 27%. But look at in FY23, the margins were at 33%. Now, the fluctuation that you're seeing is because of the realization impact, but company has maintained, though, at 25 to 29 to 27% margin. This is because of the operating leverage that I was talking about and the cost optimization strategies that the company has seen. In March 24, the EBITDA margin impact was led by lower realizations and the volumes. In March 25, if you see, the margins have increased because of the operational efficiencies, and management is expecting that the 27-28% margins will continue. We need to ask on that. So overall, we would say, because of the fluctuations and because of the realizations impact that the company has seen, we would give a neutral rating for when it comes to income statement.
How much of an impact does raw material make on something like a GHCL?
Yeah, so we would have a number to that, but yes, this would have an impact, and that's also one of the reasons.
So that's the other lever. So there are two levers which are basically impacting that margin number, is what I'm trying to spell out. One is obviously your realizations, and the other one is your raw material cost.
But I would say the more impact has been caused by realizations.
100%. It's all realizations.
Yes,
and
it's
then
all
there is some impact of raw material prices as well. But one thing, generally when we see some of these chemical companies and we see impact on margins from realizations or raw material costs or both, right? This is that one company which sits on the confluence of it, where you have impact of both. You don't see a 20% plus margin number on a consistent basis.
Yeah.
That's something we are seeing where GHCL is concerned. And you're seeing very, very strong return ratios, which will come up on your screen as one of the metrics. But let me therefore start quickly and talk about the balance sheet. And the balance sheet, I mentioned a few nuggets from it. There's decent equity holding for a 5,000 odd crore company. The total book value is at 3,500 crore, which is decent. The borrowing number is largely quite contained in that sense that FY25 number is incorrect. We'll have to change that number. The cash and bank balance also seems fairly okay, like there's no concern per se. The borrowing number is currently at 120 crore, so it's fairly low. It was around 210 crore at the end of FY24 and around 360 crore, and before that it was 1,000 crore plus in FY20. That's where some of the concerns have crept in. But a lot of the concerns have gone away because the borrowing number has come down sharply, both FY23, FY24, FY25. The borrowing number has come down. When you're looking at the cash flow though, let me throw it across to Varsha. So thumbs up with regard to the balance sheet, no concerns per se. Positive with regard to the cash generating from operations, and also the kind of balance sheet that it has, fairly clean. Talk about the cash flow, Varsha. Yeah,
so cash flow overall, Harsh, if you see, I mean, not bad. The negative net cash flow that you're seeing for FY23 and for FY24 is because company has been investing a lot. In fact, if in FY23, company has invested almost 358 crores. In FY24, it invested 107 crores. So overall, because of a lot of investing activities, you're seeing this, negative cash flow for in FY22, in FY23. But overall, because of the expansion that the company is going into, we are seeing this, some of the negative cash flow. But overall, Harsh, for a company like, which is investing a lot, a cash flow seems a decent one.
Yes, absolutely. So you've got a decent kind of cash flow coming through, and they're distributing also a decent amount of dividend. So they do around 100 crore of dividend. Out of the 600 crore of cash flow, at least last year, let me try and break it up. 300 crore has gone into capex. Around 100 to 200 crore has gone into, 100 crore has gone into repayment of debt. And thereafter, around 100 to 200 crore has been paid out in terms of dividend. So you've got return to shareholders which have come through as a result of that. So that's the broad brush breakup of how they've opted to utilize their cash flow from operations. And likely to happen, very similar kind of likelihood in FY26 as well. But we'll get a better perspective on that. Now, I know I have to move quickly. Let's talk about the return ratios. And return ratios fairly decent. They've been either mid-teens or we've seen spikes with regard to returns. And obviously that depends. It's a function of profitability. And but regardless, those return ratios above 16% all throughout. And remember, there's some amount of debt sitting in FY20, 21, which has now tapered down. So a lot of this is going to be ROCE equals ROE. And therefore, you're going to see a decentish kind of a hold up with regard to that ROE number, and a lot of it is now getting reinvested in the new capacities that they are setting up. So that's with regard to return ratio, shareholding pattern, Varsha.
So overall, on the promoter side, if you see, Harsh, the stake has been like 18 to 19%. I mean, we would like companies, who are going for, I mean, the skin in the game matters a lot. But if you see, FII's holdings has been decent, DII holding has been decent, though the public holding has been lot at almost 44%. The only concern is, at 18% of stake, which is, because Harsh, we have normally seen companies having 40, 45% or more than 50, 60, 70% of stake in the company. Over here, it's only 19%. That's the only concern. But yeah, FII's and DII's stake has been good, and this is one of the reasons why we have given a neutral rating, when it comes to shareholding pattern.
Okay, let's talk about street cred very quickly. And within that street cred, you look at the near term, it's not been too great, understandably so. There's been some pressure, but you look at the 5-year period, the stock has been a 3.5 bagger. So it's been decent from a long-term perspective, tough from a short-term perspective, and therefore we've given this one a neutral. You want to talk about valuations and maybe to some extent analyst recommendations? Okay, I'll take up analyst recommendations.
Yes, so on valuation side, considering FY26 and FY27, the stock is at like 8 at a PE of 8, considering FY26. Now, the numbers are taken from Bloomberg. Just to know that in FY27 basis, FY27 the company is getting at almost 7 PE, which is quite at a cheaper valuation. But we also have to consider the historical financial ability that the company has seen, and that's also maybe one of the reasons why not a premium valuation has been given to. But if company shows some growth, this is like at 7-8 PE, I mean, it's a good valuation.
Okay, so that's on the valuation side. Well, not too much coverage to talk about, but whatever it is, let's quickly show it. We've got 2 buy calls, 1 hold call, if I recall right. 46% upside is more than decent, and that's also a function of the way valuations have evolved. But there are plenty of changing pieces on the balance sheet side where debt has come down. So what you want to also do and also see is that balance sheet. Keep that in mind, because that debt has come down, and while your valuations have also remained largely in line with the 5-year average, that is the big change that's happened. Overall, no thumbs down is the other piece that stands out for me, and therefore this one gets a fairly decent 6 out of 8. I would believe it's 5.5 out of 8 on the final KYC rating. So anyway, let's quickly go across. We have Mr. R S Jalan, who's the managing director at GHCL, joining us. Sir, let me first start off with the China factor. How much of that is playing out with regard and impacting your realizations? Are we seeing any of that as a significant concern currently?
Oh, thank you, Harsh, and good morning to both
Good
of
morning,
you.
sir.
Uh, I think very nicely you have presented the whole history of GSCL.
Thank you, sir.
And before I respond to this your China situation, which you have just asked for, I just want to give you some perspective of the GSCL. See, in the GSL, we are having around 40 years of the legacy. In this 40 years, now we are one of the largest soda ash producer in a single location in India. The second, our market share is around 26%, which used to be around 15 years back, used to be around only 15%. So we have moved our needle from 15% to 26% market share. Our capacity has gone up double in last 15 years, and our revenue has gone by 3 times. Our profitability has gone by 8 to 9 times in last 10 to 15 years, and our market capitalization has gone up by 25 times. So I would say, Harsh and Varsha, that in last 15 years, we have created a very strong foundation for the GHCL, where we are one of the cost leader in the margin leader in this industry. Second, we have created a long value for our stakeholders, and we have a kind of a long legacy. I just want to add one more thing here, is that our cash flow at this point of a time, as you very rightly said, from a debt of around 2,000 crore around 12 years back, we are today 1,000 crore plus in the balance sheet. So this is what the journey which we have gone through. Now coming back to your point on China, the China has around 45% of the global capacity. Against 80 million tons of the total global capacity, they have something around 38, 39 million tons of the capacity. And obviously, China has some a major role to play in the global scenario. But good thing which has happened in China in last 2 years is that on one side they have added the capacity of around 10 million ton, but on the other side the demand has also been very phenomenally very high, up around 10 to 18%. In 2023 it was 10%, and in 2024 it was 18% growth, which was a very phenomenal growth. Of course, currently in the short period of last 5 months, their capacity has been, or their market or their demand outlook is slow, and because of that, there is no growth in calendar year 25. Yes, in the short term, definitely we see a kind of a implication of China's scenario onto the overall global soda ash business, and that will definitely have an impact on the Indian industry as well.
So the pricing pressure is still expected. So will that impact your Q2? Because I remember that last time you said that the Q2 will be impacted, but now since we are very near to the Q2, how is Q2 looking?
Yes, Varsha, Q2 and maybe 1 or 2 more quarters is definitely going to be challenging for the industry per se. But like I said, if you look at the slightly longer terms in this business, like you have very rightly presented the number, our EBITDA margin is in the range of around 25 to 30% kind of a margin range. And I think if you look at maybe 2 years down the line, probably you will see a kind of that kind of a margin will continue to be there. I just want to highlight one more thing here. Is like you very rightly given the number in 2024 versus 25. On one side, our prices has gone down by 19%, but our bottom line is only hit by around 4 to 5%. And this is all not because of only the raw material prices. This is all because of the operational efficiency which we have built in our business over a period of time. And this capabilities of ours will continue to drive us from it on a different level of scales.
Understood, sir. Sir, talk to us about where does the top line go? You're adding capacity. You've guided for 2 to 3% growth in FY26, if I'm not wrong, and we've built that into what we've built into our valuation metrics. But talk to us about beyond that. Bromine comes on stream. You also have fresh capacity of soda ash coming on stream. When does that come, and how much does that add to the top line? Give us that perspective. What does it take your potential top line to? I understand realizations are fluctuating, but give us that perspective.
Right, Harsh, in this year, 25, 26, we will have both the capacity of your bromine, which is, as you rightly said, 2,800 tons will get added to this, and maybe last quarter of this year, that will come on stream, and our vacuum salt will also come on stream on the last quarter. Beyond that, in next 5 years, our vision for 2030, because we are setting up a new greenfield project where we have a vision of around doubling the capacity what we have right now. From 1.2 million ton, which we have currently, it will go to 2.3 million ton. And you can imagine this number going just going to be double than what the revenue we have and all other numbers.
Also, sir, with with so just on the extension of this question that Harsh was talking about, I just wanted to know, because of this, the capacity expansion that you're seeing over the longer period of time, how are you seeing the EBITDA margin, increase? Will you see the increase in EBITDA margin because of the value-added products that you're going into, and because of the expansion, that you are doing? So, any kind of a ballpark, a number that you could give us on margins for the next, 2 years?
See, when you talk about the next 2 years, like I said, our capacity of the new greenfield project will be coming in the only after 3 years. So that's number one. So therefore, the margin expansion on that soda ash business will be after 3 years. Yes, bromine and your vacuum salt will definitely improve our overall margin, but the percentage of that in the overall revenue will be not very significant, and that may not lead to kind of a very significant overall margin increasing in the business. But that will obviously add to the bottom in terms of the absolute number will get added.
The balance sheet metrics on your screen now, that borrowing number clearly visible. Mr. Jalan, I want to understand, you're doing plenty of capex. How much you've guided for 300 crore over the next couple of years? For how long is this kind of capex cycle going to last you? And what's the return? Because 300 crore over the next 2 years, even 600 crore is virtually nearly 10% of your market cap, or more than that, in fact. So talk to us also about the return ratios. What does it do to that number? What's the aspirational return ratio you want to maintain as a floor, as the absolute minimum?
See, Harsh, if I can talk about this 300 crores which we are talking about, primarily these numbers are going into two parts. One is the bromine and vacuum salt business, that is number one. And there the return ratio will be very, very significantly higher, which will be something around more than 30%. The second is the operational efficiency which we are I spoke about it. So that will also kind of help us to kind of maintain or improve our margins. Overall, in these numbers, probably you can visualize a kind of a return ratio of around more than 20-22%.
Sir, just my quick last question is that, of course, as the capex cycle will play out, what do you do with the cash flow? Does this mean better dividends to shareholders? Because you'll have 300 crore of free cash flow, your debt is now sub 100 crore. Give us that quick perspective, sir. I have only 20 seconds, sorry.
Yeah, Harsh, I think the board will definitely take a call on that. But like I said, we have to invest around 6,500 crores into the new greenfield project that will start getting spent after 2 years. So probably we will kind of have a discipline of the growth as well as the dividend to the reward to the shareholders.
No more reduction in debt, sir. Is that the right way to think of this?
No, we don't have a debt, Harsh, right now.
Correct. Sub 100 crore. So broadly, it will entirely be either dividend, either capex. Is that the right way to think?
Yes, capex.
Perfect. Thank you so much, Mr. Jalan, for coming in and giving us that perspective. Of course, this likely means that your dividend yields will go up as a result of this. That's what I was really looking for. Anyway, viewers, completely out of time on this edition of the show. From Varsha, myself, everyone who puts this show together, thanks so much for watching.